Gold manipulation is back, and I've got the proof. Last Friday, we saw a sudden, inexplicable $50 drop in gold prices at exactly 4 p.m. London time. This isn't a coincidence. It's a pattern we've seen before. I've spent weeks analyzing recent market data, studying historical cases, and connecting the dots. What I've uncovered is shocking. The same tactics used by major banks in past scandals are resurfacing. But why now? Who's behind it? And most importantly, how can you, as an investor, turn this to your advantage? Stay tuned, because I'm about to blow this wide open. Gold price manipulation isn't new. It's been happening for decades. Back in the early 2000s, many market watchers, including myself, noticed strange patterns in gold prices. We'd see sudden, sharp drops that didn't make sense given market conditions. These weren't normal price movements. They were too abrupt, too precise. At first, people dismissed these claims as conspiracy theories. But we kept digging. We tracked these abnormal price movements, analyzed trading patterns, and gathered evidence. Slowly, a picture emerged of systematic manipulation by some of the world's largest banks. The breakthrough came in 2014, when legal proceedings began against major players like Deutsche Bank, HSBC, and JP Morgan. These weren't just slaps on the wrist. We're talking about multi-million-dollar fines and even jail time for some traders. The courts confirmed what we'd suspected all along. Gold prices were being manipulated through practices like spoofing and other deceptive trading tactics. These revelations shook the financial world. For years, the manipulation seemed to decrease as banks faced increased scrutiny. But now, as we'll see, there are signs that these old tactics might be making a comeback. Understanding this history is crucial because it shows us what to look out for in today's market. Let's break down how gold price manipulation typically works. Imagine you're a big player in the gold market, a major bank or hedge fund. You want to sell a large amount of gold, but you know that flooding the market with sell orders will drive the price down. So what do? You use a trick called spoofing. Here's how it works. Instead of selling, you place a huge buy order for gold. This isn't a real order. You have no intention of following through. But other traders see this massive buy order and think, wow, someone's betting big on gold going up. They start buying gold, driving the price higher. Then, at just the right moment, you cancel your fake buy order and sell your actual gold at the inflated price. It's like a bait and switch, but with millions of dollars at stake. Another tactic is strategically timed selling. Manipulators often dump large amounts of gold futures contracts when the market is least liquid, like late at night or during holidays. This causes outsized price drops that don't reflect real market conditions. There's also the issue of the London gold fixing. Twice a day, a small group of banks set the benchmark price for gold. This process has been criticized for being opaque and potentially open to abuse. These tactics can create artificial price swings, shaking out smaller investors and distorting the true value of gold. It's not just unfair, it's illegal. But the potential profits are so massive that some traders are willing to risk it. Understanding these methods is crucial because it helps us spot when manipulation might be happening. And as we'll see next, there's evidence suggesting these old tricks are making a comeback in today's market. Let's dive into some of the most infamous cases of gold manipulation that rocked the financial world. These aren't conspiracy theories. These are proven cases that led to massive fines and even jail time. First up, JP Morgan Chase. In 2020, they were slapped with a whopping $920 million fine for manipulating precious metals futures and treasury securities. The bank's traders engaged in thousands of episodes of unlawful trading over 8 years. This wasn't just a slap on the wrist, it was the largest fine ever imposed for spoofing. Deutsche Bank also found itself in hot water. In 2016, they agreed to pay $60 million to settle private U.S. lawsuits accusing them of conspiring to manipulate gold prices. But that's not all. They also turned over 350,000 pages of documents and 75 audio tapes to help prosecutors build cases against other banks. This cooperation led to a treasure trove of evidence against other major players. HSBC and UBS didn't escape unscathed either. In 2018, both banks were fined by the U.S. Commodity Futures Trading Commission for spoofing in precious metals markets. HSBC had to cough up $1.6 million, while UBS paid $15 million, but perhaps the most shocking case involved the former J.P. Morgan head of precious metals trading, Michael Nowak, and his top gold trader, Greg Smith. In 2022, they were convicted of fraud and market manipulation. These weren't low-level employees. These were top executives engaging in systemic fraud. These cases sent shockwaves through the financial industry. They proved that gold manipulation wasn't just the realm of conspiracy theorists. It was a real, pervasive problem involving some of the world's largest banks. The question now is, have these practices really stopped, or are they just becoming more sophisticated? Now, let's talk about the London gold fixing, a crucial piece of the puzzle in understanding gold price manipulation. Twice a day, at 10:30 a.m. and 3:00 p.m. London time, a small group of banks set the benchmark price for gold. This price affects everything from jewelry prices to complex financial products. Here's the kicker. For decades, this process was shrouded in secrecy. A handful of bankers would get on a conference call and decide the global gold price. No transparency, no oversight. It was like a private club controlling a global market. The significance? This opaque system was ripe for abuse. Banks could potentially front-run orders, meaning they could trade on insider knowledge before the price was set. It's like knowing the winning lottery numbers before they're announced. In 2014, after mounting criticism and regulatory scrutiny, the system was overhauled. The Old Boys Club was replaced with an electronic auction system. More banks were allowed to participate, and there was supposed to be more transparency. But here's the thing. Even with these changes, the London gold fixing still wields enormous power. That 3:00 p.m. fixing, which is 10 a.m. New York time, can cause huge price swings. And as we'll see in a moment, there's evidence suggesting that manipulation around this time hasn't entirely disappeared. Understanding the London gold fixing is crucial because it's often the epicenter of suspicious price movements. It's where the big players flex their muscles and where small investors can get caught in the crossfire. Now, let's get to the heart of the matter. The recent evidence that suggests gold manipulation might be making a comeback. Last Friday, we saw something that set off alarm bells for anyone who's been watching this market closely. At exactly 4:00 p.m. London time, which is 11:00 a.m. in New York, the gold price suddenly plummeted. We're not talking about a small dip. The price dropped by $50 in just 30 minutes. That's a massive move in the gold market, especially considering there was no major news or event to trigger it. What makes this even more suspicious is the timing. It happened right after the London gold fixing, during a period of high liquidity when U.S. markets were in full swing. This is exactly the kind of pattern we used to see during the height of gold manipulation years ago. But here's where it gets really interesting. At the same time gold was dropping, the U.S. dollar was weakening. Typically, when the dollar weakens, gold prices go up. It's one of the most reliable correlations in finance. But on Friday, we saw the opposite. It's like gravity suddenly started working in reverse. And it's not just a one-off event. Over the past few weeks, I've noticed several instances of gold prices behaving erratically, often around the same time of day. We're seeing large sell orders hitting the market at odd hours, causing brief but sharp price drops. Now, I want to be clear. This isn't definitive proof of manipulation. Markets can be unpredictable, and correlation doesn't always mean causation. But for those of us who've studied the gold market for years, these patterns are eerily familiar. They bear a striking resemblance to the tactics used in the manipulation scandals of the past decade. So why might this be happening now? And what does it mean for investors? That's exactly what we're going to explore next. So why might gold manipulation be making a comeback now? There are a few key factors at play here. First, we're in a period of economic uncertainty. Inflation fears, geopolitical tensions, and market volatility are all driving increased interest in gold. When gold becomes a hot commodity, the incentive to manipulate its price grows. Second, regulatory attention has shifted. After the big crackdowns a few years ago, regulators turned their focus to other areas like cryptocurrencies. This could create a window of opportunity for bad actors to slip back into old habits. Third, technology has advanced. While this has improved market surveillance, it's also given manipulators new tools. High-frequency trading algorithms can execute complex strategies in milliseconds, making manipulation harder to detect and prove. Fourth, there's the issue of gold's role in the global financial system. As some countries move to de-dollarize and increase their gold reserves, there's more at stake in controlling the gold price. Lastly, we can't ignore the profit motive. With gold prices at historically high levels, even small manipulations can yield massive profits. For some traders, the potential gains might outweigh the risk of getting caught. Now, I'm not saying manipulation is definitely happening, but these factors create a perfect storm of conditions where it could occur. As investors, we need to be aware of these possibilities and understand how they might affect our portfolios. Now, let's talk about how savvy investors can actually benefit from these potential manipulations. First off, if you see sudden, unexplained drops in gold prices, especially around the London fix times, these could be buying opportunities. These artificial dips often recover quickly, allowing you to snag gold at a discount. Consider setting up price alerts for significant gold movements. If you see a sharp drop, especially one that doesn't align with other market indicators, it might be time to act. But remember, timing is crucial here. Another strategy is to focus on physical gold, or certain gold ETFs that are less susceptible to short-term price swings. These can provide a more stable investment during periods of potential manipulation. Lastly, diversification is key. While gold is a valuable part of any portfolio, don't put all your eggs in one basket. A mix of assets can help protect you from the impact of any single market's manipulation. Remember, the goal isn't to outsmart the manipulators, but to use their actions to your advantage. By staying informed and alert, you can turn these market distortions into potential profit opportunities. Despite these potential manipulations, the long-term outlook for gold remains strong. Economic uncertainties, geopolitical tensions, and inflation concerns continue to support gold's value. Remember, manipulations are typically short-term distortions. They don't change the fundamental factors driving gold's price. Smart investors look beyond these short-term fluctuations and focus on the bigger picture. Gold has been a store of value for thousands of years, and that's unlikely to change anytime soon. What do you think? Will gold hit new all-time highs this year, despite these manipulation attempts? Let me know in the comments. And if you found this analysis helpful, hit that like button and subscribe for more insights into the precious metals market.